right. Welcome, welcome, welcome. Happy summer, everyone who is joining us live, as well as those of you watching the recording afterwards. I hope wherever you are now is fantastic and you're living life up during this summer season. So today is our mid-year Q2 update, a ton of content to get into. So I hope you have your most comfy seat and your favorite drink. As we kick things off today, you can probably see some new faces in the gallery. Excuse me as I let in some more folks. We have had a number of new people join us, and so we wanted to start off this mid-year of just doing a round robin and having some of the newer folks introduce themselves, perhaps reintroduce themselves if it's been a month or two, as well as I completely lost my train of thought. So without any further ado, I'll hand it over to Serge to get us started, get intros, and then we'll dive into some kind of macro updates on self-storage, markets, debt, and then into the nitty-gritty of the properties. So Serge, over to you.
Thank you. First, I want to thank everybody for joining us. This is a little bit different in terms of our format. Typically, we've kind of concentrated it relative to the portfolio update. We wanted to bring everybody together for you to have a view of the team that is managing the portfolio and driving our collective returns. Karen and I have worked tirelessly over probably the last year to build the team that is going to propel us forward. You're going to hear some general market updates, and then we're going to dive into the specific projects and the portfolio. And then towards the end, as time allows, we can talk about some new investment opportunities. But first, thank you for joining us. I want to start by expressing our gratitude for a lot of the support and feedback that we've gotten relative to transparency reporting. We've gotten a lot of great comments. Keep that up. If there's anything that you're seeing or not seeing, let us know. That's how we continue to improve. I want to start by emphasizing our commitment to the safety and risk management of our portfolio. It starts with us being diligent in how we've applied debt in acquiring the assets that we have, and we're in a very strong position relative to the broader markets. And in general, we have no debt risk now. In fact, our latest acquisitions, which we got under contract last year, we've been very diligent in applying debt there. As markets are stabilizing right now from a debt perspective, we're starting to see the other side of whatever is looming over the next year. So we're super excited about that. We're very well positioned for where we are at now and where we're going forward. You're going to hear a little bit about the market shift. As everybody knows, COVID kind of threw a monkey wrench into a lot of historical norms in real estate, investing, and self-storage. We'll talk a little bit about what we've seen in terms of historical peak and occupancy numbers, revenue numbers, and now the rebalancing or getting back to what we consider a little bit more normal shifts. So there's a lot of reading of the tea leaves and understanding where things are at and responding. So there's a lot of dynamic things happening at play right now. We're going to talk a little, Ethan's going to give an update on broader capital markets. Federal Reserve just announced a half hour ago they raised interest rates a quarter point. They also suggested another rate hike before the end of the year. That likely seems like that is going to cap this rate increase cycle, which has been historic in the number of hikes in the period of time. And we'll talk about how that impacts or how we're evaluating that going forward. And then overall, just really want to provide a dynamic opportunity for you to ask questions. We're going to have a little bit more of a conversation type of review here to try and make it a little bit more different. It's kind of part team meeting and then part investor update. So if you have any questions, so we can get through the agenda as quick as possible, throw them in the chat. We'll monitor that. Otherwise, as you hear our team speaking and introducing themselves, know that we are building our platform to be a resource for you all. We want our investor community to be as well informed as possible, but also an extension of your own investment team. So to the extent whether they are investments in assets that we've acquired together, or we can help in any regard relative to other investments we have, I want to make sure that we extend our capabilities and expertise above and beyond what we're doing together. So without further ado, let me turn it over to Mike to kick us off with some intros.
Sure. Hey, everybody, let me just reintroduce myself to everybody in the call. Thanks for joining us today. I'm Mike Baillargeon. I am the Chief Operating Officer for Hearthfire. Quick little background on me. I've got actually 25 years in self-storage. I had been saying 23, and then it dawned on me that I had done some acquisitions work with public storage before getting into operations. So it's now an even 25 in storage, in a series of operational leadership roles with public storage, extra space storage, the store space guys, and joined Hearthfire back in December. Married, 4 kids, 3 of them have flown the nest already, thankfully, so it's a little quieter here. So we've replaced them with dogs. So we have 2 dogs to replace the 3 kids that have left the nest. And we're proud residents of Auburndale, Florida, down in the Tampa market. You know, I like to think that I bring a fair depth of expertise to Hearthfire. I've operated hundreds of stores. I've participated in acquisitions of hundreds of stores, seen a lot in the storage industry in the 25 years going back to 1998. God, I sound old. And I want to be a resource for everybody on the call, including our investors. So feel free to reach out to me for anything you may need. I'm also going to wear, I've got Henry Metcalf's proxy. So you'll see him. He's on the left side of your screen there in that little bubble. Henry is our Director of Acquisitions. Henry joined us back in late Q1. Henry has done a fantastic job after coming from Lightbox Storage Partners, and he and I actually spent a little time together at Extra Space. I was, believe it or not, out in Utah. Utah was not ready for me, but we had a lot of fun. Henry has implemented a fantastic acquisition strategy, super effective, sent out an update this week before he left for a week of fun in the Southern California sun at Disneyland, not Disney World. He was very careful to make sure that we knew that he was not in Florida, so I could not go find him. But we're excited to have Henry as part of our team. He's leading our acquisition strategy, doing a fantastic job. Let me hand it over to Will to introduce himself.
Yeah, good afternoon. I'm Will Lockard. We may have met on previous calls. I'm the Director of Construction for Hearthfire, and I've been with the team for a little over a year and a half now. Currently, I'm based out of York, Pennsylvania. I don't have any kids, but I am a single father to 2 black cats. So no little humans for me yet. I've been in self-storage for over 10 years. And previously, I've ran a GC and self-storage focused construction company. Over those 10 years, I've been involved with the construction of over 1 million square feet in self-storage. So like Sergio offered earlier, if you're interested in more information on the entitlement process, construction process, that we employ here at Hearthfire, or any general questions, feel free to reach out.
Excellent. Thanks, Will. Let's go out of order a little bit. Let's skip over Ethan. We'll save him for last because he's that impressive. And we'll go to Mike Capraro, Mike C, who's on the screen in his bright blue shirt. Mike, would you introduce yourself to everybody in the call?
Yeah. Hi, everybody. Yeah, my name is Mike Capraro, and came over from Store Space. Actually worked with Mike over at Store Space, and I was the Director of Asset Management, Corporate Finance over there. We had about $1 billion under management, over 100 store locations. I was responsible for building out the entire asset management infrastructure and really formalizing all the reporting to our investor base, I live here in Orlando with my fiance, and I have a lot of good experience in corporate finance, across investment banking, turnaround structuring, um, retail banking. So a very good variety of experience across all different areas within the industry. Coming up over 10 years corporate finance experience as well. So very relevant to what we're doing. I also have, similar to Ethan, some capital markets experience with my time in investment banking. Did 4 years on the sell side, placed several $100 million in capital, and really responsible for structuring, getting these deals out to the market. I think it's going to really help the investors here, with my experience coming in, really being able to formalize the reporting process, getting your hands around some of the data that we're collecting as far as from a KPI perspective as well as financials, and really getting everything tied up and really being able to present that to you guys on future investment calls. I think it's going to add a lot of value. I want to be here for you guys as well as a resource. So anything that you guys might have, form of questions, anything that you'd like me to look into, more than happy to either jump on a call, follow up through email. However I could help, I'm ready. So thank you guys.
Awesome. Thanks, Mike. Before we get to Ethan, I wanted to introduce, we have actually a special guest who has not even officially joined Hearthfire yet, but we are so excited to have her joining the team. She's down in the left corner of my screen. I'm not sure if she's in the same spot on everybody's screen, but Ashley Boyd has joined us. She's joined Hearthfire as our marketing manager. Ashley, you're muted. So if you say anything super exciting, then just know that. You can unmute yourself if you'd like. There you go.
Hey everyone. Yeah, I think I'm the newest team member, or will be the newest team member. So I'm super excited. I'm coming from a background in multifamily. I was doing that for about 15 years. Strong marketing background. The last company I worked with, we had a lot of acquisitions and dispositions. So I got to touch on working with our investors. So I'm super excited to bring, my on the boots experience, on the ground experience to Hearthfire, and I'm ready to get running next week. Can't wait.
We're excited. Welcome, Ashley.
Thank you.
Now I know everybody's we've gotten everybody excited for this big intro. So Ethan, I'm going to turn it over to you to introduce yourself to everybody in the call.
I appreciate the hype. Mike B is my hype guy. Thank you. Hi, everyone. I'm Ethan Blum. I'm Director of Capital Markets for Hearthfire. It's great to meet everyone. It's great to be here. I live in Morris County, New Jersey, less than a couple hours from our headquarters. I'm married with 2 children, and these days I can definitely tell you that my family and Hearthfire are my 2 biggest passions and focal points that run my life, for sure, in a good way, both in a good way. I joined Hearthfire a few months ago. I was previously at a couple large New York City-based commercial real estate firms, one in a broker's capacity and one on the principal development side capacity for 15 years, where I originated or participated in over $1 billion of commercial real estate debt and equity financings nationwide. That could be senior debt, an equity partner, mezz, pref, et cetera. During the 07-08 downturn, I had a pretty good view of the action from the principal side, and I think that provided a helpful perspective as this industry tends to be extremely cyclical. I have a great deal of exposure to and experience in different types of transactions and counterparties, and that's important because having direct relationships with the originators at banks and debt funds and life insurance companies and other major lending types is really crucial to getting our name and our enterprise out there and in front of folks, as well as our specific deals in front of them to evaluate. And really excited to be here. I've been enamored with self-storage, love this asset class, and huge runway ahead for this firm, and just extremely thrilled to be here and to meet all of you. From here, we'll get into sort of just from a macro perspective, capital markets and where we are today. It's a perfect day to be talking about this, given that within just the last hour or two, the Fed did raise rates, so it's very timely. And I'll talk about that we'll talk about that for a second here. So, I mean, despite the rate hike, I mean, first of all, this rate hike has been baked into the market for a few weeks now, as it's been anticipated. And so as we're on calls this week with lenders, those rates are already reflecting the pricing at these institutions. So that's just important to know. And really, frankly, like, the older you are, the better these rates are, because relative to the last 30, 40 years of history, rates are still pretty low. I mean, we tend to have, people in finance tend to have short memories sometimes. The older generations have longer memories, and it has served them well. And so rates are still quite low from a historical standpoint. And we're very optimistic about being able to execute and make them accretive to our projects, which is a segue into sort of my prime role. Our capital markets endeavors that I oversee, they're crucial to how we secure and fund our projects. Lower interest rates and better structure on our loans is extremely accretive to our project level returns. And when you have higher project level returns, that obviously trickles down into higher investor returns. And so I can control our reach to this capital markets community and how we set ourselves up for both the near term and future success with counterparties. And so you may have heard of, there's some distress and some uncertainty in the markets, but frankly, it really has not impacted self-storage nearly as much as other asset classes, such as office or retail, right? Office and retail have been around for a very long time. We're sort of primed for a revamping or a change, whereas self-storage continues to kind of climb the mountain and be a bit newer, and it's been extremely resilient to recessions and kind of blips in the economic radar. So we continue to see really robust lending activity in our space. Our approach is to identify both local and national lenders to strategically discuss our projects specifically with these decision makers. And when you're doing self-storage construction, which is a major focus of ours, that tends to be banks and private lending institutions or debt funds. Our existing debt book, so the loans that are across our existing portfolio, they're extremely strong, outperforming the current market if you were to go out there and get those same loans today. And presently, they're reacting very favorably to the deals that we have out in the market right now, certainly at below market levels for where I would expect things to price. So a lot of excitement and a lot of future success from capitalizing these from lenders.
And one thing that's worth mentioning with Ethan coming on board is it stresses our view when it comes to risk management. One of the biggest areas of risk, inherent and hidden risk in a lot of projects, is efficient, effective, and conservative utilization of debt. There are a lot of assets out there, firms that are working behind the scenes to reposition assets because they didn't apply the right debt terms to a given project. So in bringing in Ethan, it was important that we brought in someone with institutional knowledge of the application of debt. That's important now because of where our assets are relative to their business plan, but also coming out of these projects, that's also critical, whether it's navigating prepayment penalties, opportunities to refinance, that type of thing. So Ethan is going to be instrumental in helping facilitate that and really help make sure that our risks are controlled as well as they are right now going forward.
Yeah, I think that's an excellent point. And where a lot of developers get into trouble is over leveraging or being too risky. And certainly our focus is risk management and protecting investor capital and investor returns. And so we'll continue down that path for sure.
Ethan, one last thing before we jump on to the broader markets is Ethan has been instrumental in developing the Hearthfire Income Fund, which will, if there's time and you have the availability, we have a full packed schedule right now, but we'll play it by ear. We'll record it as well. There's going to be a broader announcement. Our existing investors have been introduced to the income fund. Basically, it's a fixed rate of return debt fund that we are providing 7 to 10% returns to investors. This is really intended to fill a gap that's in the broader capital markets right now. And Ethan has been instrumental in building that out. It's really institutional type of fund. There are a lot of similar funds out there that are primarily tied to fix and flips loans. Fix and flip loans, if you don't know, typically have about a 10% default rate. Self-storage loans are about 2%. So from a risk perspective, it's significant to where it fits in a investor portfolio is significant relative to risk-adjusted return. So we'll get into a little bit that on the end of this. Mike?
Yep. So thanks, guys. Let me just summarize kind of where we're going to go with the next few slides. So just a couple of slides on the state of storage in general. I think we're in a predictable spot in storage, and then we'll get into the portfolio right from there. So go ahead. So what I wanted to share with you guys, our friends over at Hoya Capital do a nice job of putting together graphics, and this one's a little dense. So feel free to ask for a copy of the slide. We'll send you a copy of that. But what I wanted to share with everybody is the tracking that Hoya does on the square foot occupancy of all of the REITs on a quarterly basis. So this is combining extra, acute, public, life, which is now extra, NSA, and giving you an average, which is the blue line. I share this with everybody to simply say this was a predictable outcome after the last couple of years. Storage markets heat up. We saw that in 21, we saw that in 22. We saw that start to end at the end of 22. And what's happened now, the last number that you see all the way to the right of the screen, which is Q4 of 2022, was simply the markets returning to the historic norm. 92.1% occupancy overall for the REITs. It was actually slightly better than the last 5 or 6 Q4 results that they all reported of anywhere from 90.5% to 91%. So wanted to just start by saying, markets have been, or rental activity has been slower this year for everybody, but I don't think there is anything at all wrong with the markets. This is simply a reversion to the norm.
One thing worth mentioning, go back to that slide real quick, please, is when we were looking at, when we spend a lot of time once our quarters are closed to analyze every property within our portfolio independently and then collectively to find patterns and how we responded. And what we found was, by and large, we kind of responded to the spike in occupancy very similar to where most of the REITs did. And what I mean by that is when you see like first quarter of 21, second quarter of 21, where it spiked, occupancy spiked 94.8, 96.4. In self-storage, the response to high occupancy is to force rates, to drive rates higher and higher, to bring your occupancy down to what is considered stabilized 90 to 92%. We did that. And what we were able to achieve in the third quarter, even into the fourth quarter of 21, was much higher revenue than otherwise we might have expected. Now, what we're still trying to understand is the reversion to norm are we going to go fully back, or are we still going to maintain an elevated level? Because if you see the fourth quarter of 22, 92.1%, all the other fourth quarters are in the low 90s. So the question we have now is, going into this cycle, going forward, can we maintain that elevated new margin of 1 to 3% greater than historical norms? That'd be wonderful, because that would mean that by and large, we're going to overshoot on revenue, overshoot on occupancy going forward. But the question is, has consumer behavior permanently changed, or did we see that spike obviously when people started working from home? You started utilizing storage, and now are being forced more and more to go into the office. I'm hopeful, and I believe that there is a good chance that we're going to see lower occupancy numbers in the low seasons going forward as well, because of a lot of the stickiness of that home, culture now from an office environment.
Yeah, I would say, well, nobody has a crystal ball, and we'll talk about that a little bit as well. Overall general answer from me is I'm bullish, and we're going to see that in our portfolio. I think you're going to see us outperforming. So wanted to share another graphic. I like to borrow graphics when they are particularly insightful. A little state of the storage community. This is the CPPI, which is Green Street's Commercial Property Price Index. Just wanted to point out that they tracked several different asset classes in real estate. And in 2021, storage jumped out of the pack and has remained out of the pack. Pricing storage facilities remains better than most other real estate asset classes. All right. So are we in a recession? Are we heading for a recession? Was there a recession? I conducted a little experiment on Monday, and I asked Google twice, same computer, just 2 different times of the day, will there be a recession? Yes, the next 12 months. And I'm not going to go through every headline that's on your screen, but side by side here are the top results that Google returned. And as you can see, they're all over the place, from we're in a recession and they're not telling us, to the Bank of America CEO saying there's no more risk of a hard landing, to there's a 20% risk, to there's a 60% risk. So the short answer is, I don't think anybody really knows. You just have to deal with the information you have. And then last but not least, on kind of the state of the storage world, I love going back to the Federal Reserve's economic data, Fred. Fred's an old friend. So I wanted to just bring Fred back out. To those of you who haven't seen Fred before, you can also find Fred online. It's the St. Louis Federal Reserve maintains Fred for self-storage. This is a pricing index. So this is giving you an index of all the street rates in the self-storage world. The gray bars or bands that are going vertically across the screen are recessionary periods in storage. So I've been through 3 official recessions in my time in storage. And why it's important to go back to Fred is to just show that storage is super resilient. This is why we talk about storage being resilient. When recessionary times hit, pricing index, you'll see it goes flat, ticks slightly downward, stays that way until you get out of that recessionary period. But every time following a recession, pricing goes higher than it was before the recession. So storage, we have found for the last, this is 30 years, about 30 years of data, has been extremely resilient. We expect it to continue to be so. All right, let's talk about the portfolio. And I'm going to run through these not super fast, but I'm going to keep the pace pretty brisk. So feel free to pop questions into the chat. Serge, I don't know if you want to talk about the timeline guide first.
Yeah, any comment on the Wall Street Journal article about self-storage? I am not aware of the article in question. Anybody aware of that?
Yeah, I read it last night, actually. So very, very timely, and glad you picked up on it. I actually did not find the article to be that negative. And I felt, especially at the end, the way it's wrapped up is in a positive light. Look, I think it's a classic case of, Amazon or Netflix, if they do $1 billion in net revenue one quarter, and then the next quarter they do 10% less on a relative basis, it may seem lower, but which it is, it's a fact, but nothing's forever, right? Nothing can continue to climb forever. And I think that this is just saying that there was a little bit of a spike in this post-COVID need. It makes a good point that, maybe as there's a return to office, it makes a very specific point about people putting like office equipment in these units. But if we really want to get into a tangent about the tailwinds of storage and the need for units as materialism in this country grows, as home ownership decreases, and people start living in more denser environments with smaller square footage. I think I actually was hoping to have to respond more to that article last night, so I didn't find it too bad. Was there anything specific in it that you wanted us to address?
It's also worth, and I just got the article, it's also worth highlighting that we had a record boom in explosion higher, which naturally would result in a record, kind of going the other way if it dropping down back to normal. I don't know the genesis of it. One thing that's worth highlighting from an industry perspective is the consolidation, extra space, and now public. Just the huge consolidation there is cornering the market there. So I don't know, how they're related, quite honestly. But we can only evaluate our property performance. A lot of the industry knowledge or data points come from the REITs, which are major metros, which are going to see a little diversion from maybe what we see in the market. And that's true for most asset classes. So we can cover that a little bit more broadly, if there's any impact to our portfolio. I do want to touch on a general overview of our broader business plans. This is kind of a reminder on how we evaluate and how we manage the individual projects and the overall portfolio. These are a value add. Every investment that we've done to date has been a value add acquisition. What that means is years 1 through 3, the goal there is to execute our business plan. Every project has a varying degree of business plans that start with obviously the acquisition and onboarding from a management perspective. Where there's expansions, it's permitting, it's construction. And that goes from year 1 into year 2. From there, it's about learning the property. In many cases, a lot of these assets have a legacy, what I would call a legacy customer base, which means they might be used to going in and chit-chatting. Corinne and I experienced this personally when we ran Bird in Hand, our first self-storage facility, where you would have customers come in, chit-chat with the manager, those types of things, where you got to change the customer behavior to be less personal and go more towards the technology side. So we implement our technology stack. From there, it's about executing on construction projects. The whole construction cycle has been elongated ever since COVID. There's some issues ongoing. Won't get into any of the municipal or political aspects around it, but everything seems to take a lot longer these days. So the first 3 years are intended executing the business plan. Distributions are limited. It's worth reminding everyone that preferred returns are simply the entitlement of the initial cash flows to investors. They're not intended to be guaranteed returns. Sometimes we get questions on, I'm not getting my preferred return. And it really is not intended to suggest that the preferred return gets paid during the business plan execution. There's a catch-up period as we optimize cash flow and catch up on distributions, which generally take place between years 3 and 4. And this is standard real estate, value add programs. I can't speak to other firms where they're able to do some things earlier than others. Won't get into how that can happen. Our objective is to raise the capital we need for the projects, execute the business plan, manage our debt covenants. That's a huge part of controlling distributions, to make sure that our debt coverage ratio stays within the limits of what banks required. Years 3 and 4 is about driving revenue, stabilizing expenses, and then preparing for peak performance and optimizing the exit IRR. Our value add projects are intended to be on the back end, equity multiple and IRR driven. That's really where we get the value and the exit pop. We're already starting to look at some of the properties that are in year 3 and starting to understand where they need to be positioned over the next year or 2. I fully believe that over the next year is probably not going to be the optimal time to sell. There may be some opportunities to sell, but by and large, it's continuing to maximize that. And then if there is a market downturn, hitting that pop on the exit would fall really nicely with the timeline that we have for the projects. So years 4 and 5 is really about the recapitalization analysis and getting to that major capital event. So wanted to kind of put this out there as a general timeline overview for all of our projects as we're going through them. Mike.
Great, thanks, Serge. So what we're going to do now is run through the funds, and Will Lockard and I are going to double team these slides a little bit. Will's going to speak to the remaining business plan, and then I'll give just a quick update on performance, and we'll go from there. So Will, Hearthfire Growth Fund 1.
Yeah, so I'll touch on Lidditz first. We're currently evaluating some additional CapEx items at this site, including some paving maintenance, lighting upgrades, reskinning some of the existing areas there to basically, pretty it up. And then we are looking at converting some of the buildings there to add additional square footage of rentable storage. For Cloverleaf, as many of you know, we dealt with some existing stormwater DEP issues from the previous owner that restricted our timeline for really executing the expansion that we wanted there. That has since been finalized. We have the open permit closed, and we are moving through the process of finalizing construction documents. July 5th, we received full zoning approval for our project, which includes a large single-story climate control building, as well as some additional drive-up non-climate. So like I said, we're working through the final design documents, and then we'll be going in for permit here once we have that finalized.
That's great. Thanks, Will. So overall, I will just make kind of a macro comment on the portfolios. You're going to see on the left bottom corner of each screen some updates on KPIs and performance. You're going to see some pretty consistent themes there with improvement in tenant protection plan penetration. That's the tenant, they pay us a fee each month for warranty coverage on their goods. You're going to see improvements in actual occupied rents. You're going to see decreases in accounts receivable or collections. And that's all really part of a plan to make sure that the properties are operating optimally before and during the delivery of our business plan. So for Hearthfire Growth Fund number 1, I think the simplest way to comment on performance is for each of the last 4 months from March through the end of June, the NOI for HGF1 matched or beat underwriting for each of those 4 months. And we expect that to continue. We're actually trending positively revenue-wise. So now, as we add the business plan execution and the addition of units or the optimization of units, we expect revenue generation to continue. A simple, quick little example of that at Cloverleaf, we recently rented the barn office space that had been on the market for a little while. While the rest of the office space industry is melting down, we actually got a rental, and we're adding $12,600 per year to the income at that property. So that's going to add another 5.5% roughly to the bottom line.
Worth noting there, going back to the business plans of this. So from a cash flow and distribution perspective, the $12,600 in rental income from that office is kind of negligible. It's not going to be something that you're going to notice in a distribution check, but from a portfolio value, it translates into over $200,000 in value. So that's how we evaluate adding value to the asset, not just top line revenue. The top line revenue is great, but it translates into value on the back end. So that's a really good example of what we are actually laser focused on is driving value.
Yeah, that's a great point, Serge. You always have to capitalize it. So excellent. All right, let's move to the next one. All right, so Londonderry. Will, talk to us about the business plan at Londonderry.
Yeah, so Londonderry, we are in the process of executing the repairs on the existing retaining wall there. That'll be happening over the next couple weeks. That's the large CapEx item that we have currently planned. We're also evaluating some other possible improvements to the site as a whole.
Great, thanks, Will. So Londonderry is probably, for me personally, it's my sore spot. Londonderry, we're seeing excellent KPIs. You can see those on the left side of the screen. We're still trailing underwriting. Net operating income is still trailing. Looking at the history, the historic performance of the property, we can see that we, in November, we achieved or exceeded our pro forma revenues. This was just prior to my joining Hearthfire, but we did the logical thing. We said, if revenue is that high, it's time to push rates. We pushed street rates, we pushed existing customer rates. What we saw as a result of that was some customer departures, move outs, and then the higher street rates slowed customers moving back in. So we've been aggressively really managing rates the last few months to come back, to bring back the occupancy, but that is the path forward here. The business plan from an operational perspective at Londonderry is pretty simple. Keep the KPIs dialed in, get the occupancy back, keep expenses, of course, under control.
And it's worth highlighting with Londonderry. This is one of those tests. This is one of those cases where we dove into the numbers and say, hey, what's going on here? And you see the November 22 spike and then the drop in revenue there, and that is consistent with the broader storage industry. But when we dialed in here, we said, all right, well, what we realized is we've achieved or exceeded peak revenue, and the peak revenue that we hit in November of 22 was higher than it would be in, say, November of 23. So we know the potential to get that revenue number, which is huge, because beyond this year, our revenue projections from underwriting are normal rate increases, 4 to 6%, which is kind of industry, which we think with the current inflationary market, we can hit. The expense ratio, or the expenses, some of the numbers that we looked at is where we missed the mark relative to where we expected rates to be or expenses to be back when we underwrote it. Utility costs are kind of 30%, 40% higher than we expected. Insurance across the board in every single asset class is about 30% higher in terms of insurance. And then we have a pretty healthy, probably double than what we expect to get that occupancy where we need it to be. And as you can see, the occupancy right now is hovering 90%. So we're almost done on the occupancy. We turn our attention to driving rates. So from there, it's just a matter of dialing in the expenses here. The good news is that distributions are going to start back up. Will did a fantastic job with identifying a better solution to the retaining wall. Initially, it was up to $200,000 to fix it, got it down to isolating the area, got some engineers to look at it, and that ultimately is coming in at $18,000. So that was a fantastic job there. We're confident in the path forward for Londonderry. So now it's just a matter of continuing to drive this thing. And this will probably be one of those assets where we're going to be exploring some options sooner rather than later with the asset.
Great. Yeah, that was helpful, Serge. Appreciate it. Growth Fund 2. Now, before I turn it over to Will, I'm just going to say this is one of the only times you're going to hear me say I'm excited about Indiana. So Will, talk to us about the business plan here.
Yeah, so this fund obviously has 3 different projects in various stages of construction currently. To start off with Old Buffalo Road, we are essentially waiting for the state review process to get back to us, really expecting it any day at this point. Indiana's plan review is an interesting one. You actually have to go through the Indiana Department of Homeland Security on anything. So the process there is a little different than some other states that we've worked in. So we're finalizing the plan review there, expecting groundbreaking still, in August. Third Road, same thing. We are expecting to break ground here in the next couple weeks. We have everything finalized there for the additional climate control building, as well as the small conversion to the building that's attached to the office there. And then Detroit Street, we've actually already begun construction there. Demo should be completed this week. We have the hallways and doors ordered, as well as subcontracts for electrical, HVAC, roofing, all being finalized this week. So we are chugging along in Indiana.
Yeah, I mean, I think that really kind of hits it on the head, Will. So why am I excited about Indiana? I'm a lifelong Patriots fan, originally from New England, so Indiana doesn't excite me very much. Why I'm excited about Indiana is, as you can see in the updates versus underwriting section on your screen, similar KPI results, the properties. We've really dialed in operations at these properties, and for the last 4 months, we've actually beaten underwriting. Net operating income rather has beaten underwriting by 8%, about 25 grand. Expenses are driving that right now until we have our product online, but we have expenses dialed in. We have our KPIs dialed in. All we need is Will to deliver that product, and we'll get that leased up, add the revenue piece, and this thing continues to take off like a rocket ship. So, Indiana is one that, feel great about.
It's worth highlighting with Growth Fund 2, and also it bodes well. It's kind of like, I look at it as a cheat sheet for the income portfolio, because half of the income portfolio, which is our latest acquisition, which also has some shares available that we'll talk about a little bit later, but it's in the same market. And what we've been able to do, and what we've been able to validate as our assumption going in here, is by controlling multiple assets in the existing market to be that brand there. We were talking about it earlier. There are no major brands in that market. So while the market doesn't have the explosive rates, from a value perspective for our investor and a risk-adjusted return, it's truly fantastic. So we're getting that boost from controlling multiple assets in the same market by us collectively driving rates. We're really doing a fantastic job. We've got an exciting, might have another opportunity to acquire yet another asset in the same market. I'm getting a little ahead of myself, but by and large, it's really a strong small market. But we're also, for reasons that we've talked about before, the state of Indiana is turning out to be probably the most friendly state for self-storage out there. And it's that secret has kind of gotten out since whoever was extra bought that other firm, and there's a lot of consolidation. So that bodes well for our portfolio as well.
Yeah, for sure. So we thought with Crete we would show before we told.
Sure. Yeah, so you can see the video there at Crete. This is a time lapse from the Ox Blue camera. I was out on site last week, took some additional pictures. We have foundations and slabs continuing to be poured this week. And we have the erecting crew on site on Friday to begin on building D. The stormwater and site work is all but complete. There's a couple little things that need cleaned up, as we finish buildings and grade for paving. But overall, we're making progress at Crete. We're also working with a couple of the subs on ways to expedite as we get buildings under roof. We have been in talks with the erecting crew about getting additional crews out there as we get slabs up. But overall, there's activity on site, and as long as weather, if it stops raining out there, we'll keep building. So.
And Will, just to make sure I'm clear on it, we can actually call for inspection and get a TCO as we deliver each building individually in Crete, right?
Yeah, that's correct, Mike. So each building, again, it's 4 buildings. Each building has its own permit, which essentially means our focus is going to be getting one building up as soon as possible, getting a CO on that so we can start renting. The goal there is to, get the first one under roof. That way all the other subs can get in there, hammer out, their scope of work. We can get an inspection while we complete the other buildings.
Excellent. Yeah, so Crete, good KPIs. We saw excellent improvements from Q1 to Q2. Not a ton of history in Crete for us, but we have expenses spot on to the underwriting. Now we just need the expansion to wrap up. We need the product, and we'll get it leased up and start generating some additional revenue. So Crete's a pretty simple one. We're ready to receive and rent.
The funny thing when it comes to Crete is we've got developed a good relationship with the local lender there. It's Providence Bank, and I get regular calls from the lender. And really odd because I've never gotten calls like this, and he's super excited, man. He goes, "You guys are going to make some real money on this project. I mean, I love how it's coming along." And so I've never had a lender as excited about a project before. So that's reassuring.
We love our debt. Great. All right, Fitchburg. Will, talk to us about Fitchburg.
Yeah, so Fitchburg is obviously a very interesting property. As with any old building that you convert, you run into challenges. This happens to be one of those situations where structurally there needs to be some improvements. We have finalized the structural plans and plan to move forward. We expect finalized pricing from multiple subs this week, and then we'll be starting on that directly. The good thing about Fitchburg is it is existing storage. What that means is there's no additional approvals needed. It's essentially a rubber stamp from the city, and we can pretty much grab a permit right away. We've also came up with a plan to move existing tenants throughout the building during construction, which will allow us to keep tenants in place and not require move outs during construction of the new hallways and doors.
Yeah, and that's really critical. I mean, obviously we want to continue to churn over time for higher and higher rents, but keeping the existing rental income base in place was a big win. We actually didn't have to cut anybody out. So, Fitchburg, I can sum up Fitchburg pretty simply. Fitchburg, we always find ourselves at least once a week scratching our head about some new challenge in Fitchburg, but Fitchburg leases up and produces revenue. There have been 0 rental challenges in terms of getting customers into Fitchburg, and you can see that represented on the graph on the screen. The gray line running from left to right is revenue. Just continues to grow. We kind of got worried actually about how many people wanted to rent in Fitchburg and how are we going to do our remix if everything was rented. So, Fitchburg KPIs look good. Expenses been a little elevated, but that's what you would expect at a remote store. So, Fitchburg is alone in Massachusetts for us. It requires a little more personnel. Expenses are obviously higher than we would have underwritten previously, but that's easy enough to dial in. As we increase our unit count, all that normalizes.
Interesting enough with Fitchburg, a couple things. We'll talk about some ability to continue to participate in the construction of Fitchburg, but Fitchburg is one of those assets. Fitchburg and Londonderry are 2 assets where we regularly get calls expressing interest to acquire them. Londonderry, not as much directly from brokers as well, but we've been approached by several brokers in the Massachusetts or Fitchburg market, really looking to tie up the property upon C of O or even exit. We've got a couple opinions on value on there, which is exciting. It bodes well because there's a lot happening in the Fitchburg market. Our partners on the project develop multifamily in there as well. So it's overall exciting when you have that kind of demand so early on with it.
Excellent. Income portfolio. So LaPorte Mini or Northvale Road in Laurel. Will, talk to us about the business plan.
Yeah, let's start with Laurel. We did finalize our memorialization of the annexation into the city of Laurel. So that is complete. That was the last step that we needed to finalize all of our permits and really move forward. That being said, we just got the call this morning that our permit is in hand, ready to go. We have finalized our GC selection for this project. So I'll be meeting with them again here yet this week to finalize timelines. But they are ready to move. So I expect groundbreaking in August on this job. Northvale Road, this is another LaPorte property. This project is currently underway. Again, this picture was last week when I was out there. We have site work beginning. I'm sure it looks a lot different now. I know it doesn't look like much currently, but they are working on getting the site graded and the stormwater, ready to go. Again, that's what we have for the income portfolio. Two projects that are moving very quickly on the construction end.
Also, and this is another kind of cheat code for the income portfolio. There are shares available. We purposely slowed the raise for this project to ensure that existing investors weren't diluted unnecessarily by new capital coming in as we waited for the construction components to move forward, but also getting our construction debt in place. Ethan is working that angle to get that debt in place. But what we're seeing is very promising performance from the existing assets that are there, as well as moving it forward. So what does that mean? That means that our return projections when we underwrote the project from an investor perspective was, 16 to 20% IRR. It's higher because if you invested today, the duration of your time in the project is compressed almost by potentially 9 months or so. So the recap on the back end is going to be significant. I don't know the exact math on how that translates into returns, but having a project this far along with permits, shovels literally in the ground, is really a fantastic opportunity to get into a value-add investment.
Yeah, and so I don't know that much else needs to be said about the income portfolio. We feel very dialed in there. We've gotten the expense mix right. June came in below underwriting. Revenue has been steadily increasing, exceeding underwriting over the first 6 months of the combined portfolio. So yeah, we feel very good about that.
So I think we got a good transition right here. We do have, we can talk more about open investment opportunities. Know that we're at the top of the hour. We crammed a lot of information there. Want to open it up. Any questions, thoughts, anything else anybody wants to share, whether it be the article, any of the materials that we presented here, or anything in general? You could throw them in the chat. You can take yourself off of mute, whatever you prefer. Raise your hand, however Zoom allows you to do that.
Or of course, you can reach out individually if you'd rather just talk with Serge one-on-one. Here we go.
All right, so
Serge,
what happened?
no question. What are the top 3 things that keep us up at night?
For me personally, it's really moving things along faster. I'm a project manager. My former life managed IT projects and that kind of thing. And the municipalities are throwing so many different roadblocks to move these projects along. Will lives and breathes this stuff on a daily basis. God bless him for having to navigate this. But things like just having to go through the Indiana Homeland Security to get a permit. And every one of these steps is like a month, 6 weeks. So it's super frustrating to move the projects along. On the Crete project, I've been frustrated. It's a combination of weather and contractors that have to manage multiple projects across. So for me, it's time. Time is money. And if I were to say I lose sleep, that's where it's at. Where I don't lose sleep is from a risk perspective on the projects. The other aspect of it is we constantly look back at our underwriting and say, how are we doing relative to it, and where we may have missed, why. I'd love for cash flow and distributions to be higher on some of the projects. But I don't lose a lot of sleep over that because I look at the overall value of the asset. The preferred return it continues to accrue. There's nothing lost there. We're well on target. If we were to sell every single asset today, we'd hit preferred return and then some. So I don't lose a lot of sleep there. But I'd like, our goal is always to give our investors the same level of comfort that we have, that everything that number one principle is very well protected. We've got no risk. We didn't raise money that we didn't need. We've got no debt, coming due. We've got no adjusting, rates being adjusted. So I don't know if that answered your question. Good. Let's see, for Growth Fund 2, what's the overall revenue for the quarter compared to estimates? Can we back up to that? Is that something MB can dig up real quick?
Yeah. So I can give you, I have year to date for revenue. We're beating budget. So estimates by 4%, 3.93.
What are the numbers behind that percentage? The actual totals? Where did we hit revenue wise?
I don't have those at hand, but I can certainly send them along, or if Mike C can pull them. I don't know if he has them. He's on mute.
Nick, can we take that as a homework assignment?
Yeah, I'm still in process of building out all the reporting charts. It'll be done up and ready, but as of now, it's going to have to be a one-off ad hoc assignment.
So next question is, do any of your new employees from last 12 months also invest in the funds? Mike is the oldest one so far, and I know Corinne and I are heavily invested. Majority of us are invested. I know Anna's invested as well. Anybody wants to share in that?
Well, something that's on our vision board is to create a vehicle for employees to be co-investing. So that's coming. That's coming.
And it's also a matter of, in some cases, there's some qualification, security stuff that we've got to navigate. So there's nothing that prohibits it. I think everybody right now is neck deep focused on building respective business areas to get that humming along.
Yeah, and Randy, I will tell you, I was about to invest, and Serge and Corinne maybe put on the earmuffs. And my wife convinced me to buy a new home that we moved into last week. So all my investment went into the new home. And if I took off the blur, you would still see the boxes behind me. And there's also an elliptical that doesn't belong here. So we're still unpacking on the close of the new home. But next cash is going there.
I love that question. We threw out the gauntlet there.
Serge, can I really quick, because I know we've got some Fitchburg investors, and we want to make sure that they very clearly see their right of first refusal for.
Yeah, let's go through.
Yes.
Could we go through this from the start? I'm going to go through this really quickly. The open opportunities. There's obviously an opportunity for reach out, schedule a call. We can do it personal. It's a little bit more of an intimate group right now. So there's just kind of highlight what we have out there right now.
And I just wanted to hit this one first because I know that the Fitchburg investors have right of first refusal. So I wanted to respect your time.
So the structure of the Fitchburg deal was we acquired this with seller financing, which means that from a construction loan perspective, most bank lenders aren't going to lend in a second position behind a seller financing. The seller financing was a ridiculous rate. It was interest only for the duration of I think it's like 5 years interest only. So it was something that we couldn't refuse. So right now the investment opportunity, again, as Corinne mentioned, Fitchburg equity investors have the right of first refusal. It's a 10% rate of return for open to any investor, but obviously again, existing investors right of first refusal. That's opening up now. So if you're an existing Fitchburg investor or you're not an investor, just let us know that you're interested in this. There's going to be more direct information coming on this over the next couple of weeks for the official invitation, but we want to put that out there. This is open now. It's a 10% rate of return, secured by the asset. The equity, we believe that a significant portion is already baked into the deal with where we're at with performance and the and what we're getting in terms of broker opinion of value upon CO. We got it as a 12-month term. I personally don't think we'll need that long, but that's open effectively now. Okay. What do you want to hit next? The income portfolio. Yeah, so the link up top is the landing page for the income portfolio. That is still open. What I will say here is the return targets of 16 to 20% IRR. That's not as fluid, or the spread is not that wide. We made it that wide because when we put this out there, there was some uncertainty around debt. We were started this project back in I think about a year or so now. Once we hit the investor equity that we needed to close on the properties, we did 1031 exchange from our exit of bird in hand self-storage, and then the rest went to construction. We intentionally pulled off the foot off of the gas from the raise standpoint because it's more accretive to existing investors to have less for the equity to be spread out over time in order to ensure that we finance the parts of the project at the right time. We're really close on getting the financing for both construction loans. As you saw, we got the, as Will talked about, we got the permits for Laurel. We've got the LaPorte is actually underway. You can see the quality of the bills that are going to be there. These are really going to be fantastic. Quite honestly, I think our return targets are super conservative, but that's just the way that we underwrite. So that's available. This is open to sophisticated and accredited investors. If you're on this call, that means you already qualify to join us. $50,000 minimum investment, preferred return of 8%, 70-30 to Class A investors, which is there's no other, the Class B is the general partners. Our projections are to recapitalize this upon stabilization or somewhere there and have a capital event where we return the investor capital and then keep going from there. So this is a fantastic opportunity. Like I said, it's very rare that you can invest in a project that is this far along where there's no construction risk. The asset is owned, being operated. For where we're at in the market cycle, I'm super excited about it.
Not to mention the debt that Ethan was able to get. I know we're still negotiating on one, but Ethan got really fantastic terms. That's your cue to jump in. I'm blanking on the numbers exactly.
We're really close to a full approval for the Laurel deal at a fixed rate for a construction loan at the right leverage level that minimizes risk and is also not ultra conservative, right? And the rate, I mean, we'll be able to formally announce it once we're closed, but it's at least a point better than market, maybe more. It's extremely attractive, and we'll hopefully have some really good news to share when it's official.
All right, the next one, and feel free to ask any questions along the way. This is our latest fund. This is the one I was talking about that Ethan was instrumental in building. So this is a Hearthfire income fund. These are fixed returns. There's 3 classes of investments, A, B, and C, with the minimums that you see there. The rate of return, again, fixed 7 to 10%. The lockup period is Class C is intended to be more for liquidity, meaning shorter duration in terms of the lockup period, and then Class A longer. This is for accredited investors only, which means that we have intentions of marketing this broadly. This is a fund that's starting out at 25 million. We just released it to our existing investors. If you're on this call, consider yourself extended the opportunity to join this. This is a fund where we've been able to identify transactional opportunities as we've been acquiring land development, and we've got a pipeline of, I think, 6 or 8 projects. So where the funds get allocated are right now first position loans for land acquisitions where we're doing land development projects. And then those projects are being converted into either retail investment opportunities or joint ventures. We just signed a term sheet on a joint venture on a Harrisonburg project. So we've already got the returns on the back end of these of the investor dollars here already secured. We look at this as a far better product, number one, from a return perspective, anything that's out there, but also from how it's positioned, meaning that these are going to be secured by self-storage, real estate. A lot of those other funds out there are volume-based and tied to fix and flips. As I mentioned, the industry statistics, there's about a 10% failure rate. If we do hit into a recession, I'm curious as to if there's a significant pullback on, single family residents and what happens to a lot of those funds. Ours is tied to self-storage. Again, what you see on your screen now is a model of utilizing quarterly compounding on a Class A investment, which is available. $200,000 investment, you can see the annual return and total return down at the bottom over the course of 5 years. If there was a commitment for that long, it becomes a fixed 12.77% rate of return. Again, the portfolio size is going to have fantastic risk management. It's going to be spread against short-term loans, bridge debt, those types of things. The initial tranche of investments are going to be our own portfolio. Once we get the platform dialed in, we will extend this to be able to support the self-storage industry as a whole, which is exciting. We want to be the premier resource for self-storage, both for our existing network and then also broadly as well. We think that that's a fantastic opportunity for us to generate the greater deals. We do have an offer for existing investors that basically for the up until I think it's the middle of August that we negotiated, that will trim the commitment period to half of what it is, meaning 3 months, 6 months, and 12 months. So the lockup period is shorter, and that's just something that we can offer for existing investors.
So in summary, and thank you to those who've been able to stay on and spend this extra time with us. Here's just a quick summary view of the 3 current open opportunities.
It is worth highlighting that our goal in our platform and investment platform going forward is to offer different products. I mean, we're getting more demand from joint ventures, family offices, even some institutions that are recognizing that it's the investment platform is being built to provide institutional quality investments. That's the team that we've brought. That's the excellence that we're expecting. We're expecting to maintain. I mean, our Corinne and my roots are in retail, friends, family. We want to maintain a product line that can support your investment goals there. And this is kind of the offerings that we have right here, right now. I don't expect from a retail equity perspective, we'll probably have 1 or 2 offerings there per year, again, depending on demand. But as we move and get a lot more demand from the bigger check sizes and partners, the opportunities there are going to be spread a little bit. So if you're interested in any of this, reach out, send any of us an email. We will be sending out a follow-up with a recording and notes following this call.
Yeah, so this is also us, asking for your feedback. Make sure that we know what your investment goals are, where you're thinking for any future things, so we can ideally align opportunities that will meet with your goals and continue to serve you. And otherwise, Serge, if you don't have any other words, I just want to say a big thank you to those of you
Yeah.
for being with us here live today, as well as those of you watching the recording. Look forward to hearing from you and seeing you at the next one.